Close your eyes for a moment. Think about your childhood bedroom. The smell of breakfast on a Saturday morning. The sound of a song that was playing everywhere the summer you turned 15. Now open your eyes. What you just felt, that warm, golden sensation spreading through your chest, that feeling has a price tag, and somebody, somewhere, is charging it to your credit card right now. Welcome to Paper Reality, where we examine the invisible machinery that turns your memories into money. Today, we're dissecting one of the most profitable psychological mechanisms ever discovered, nostalgia. Not as a feeling, not as something warm and human, but as what it actually is in the hands of corporations, a renewable financial resource that never runs out, never depreciates, and gets more valuable the older you get. By the end of this video, you'll understand exactly how much your past is worth, who's buying it, and why you'll probably hand it over willingly tomorrow morning. Let's start with a number. $83 billion. That's not the GDP of a small country. That's the estimated value of the global nostalgia market in 2024 alone. From rebooted movies to vinyl records to retro sneakers, companies aren't just selling products, they're selling your past back to you at a markup. But here's what makes this fascinating from a financial psychology perspective. Nostalgia might be the only commodity that increases in value simply by waiting. A regular asset depreciates. A car loses value the moment you drive it off the lot. But a memory appreciates. The further away your childhood gets, the more golden it becomes, and the more someone can charge you to touch it again. This is not an accident. This is architecture.
Before we can understand why nostalgia prints money, we need to understand what it does to your brain. When you experience nostalgia, your brain releases dopamine, the same chemical involved in addiction, reward-seeking, and yes, purchasing decisions. But nostalgia does something more sophisticated than just making you feel good. Research from the Journal of Consumer Research found that nostalgic feelings increase your willingness to pay by an average of 25 to 30% for the same product. Read that again. The exact same item commands a 30% premium simply because it's wrapped in your past. Why? Because nostalgia doesn't just activate your pleasure centers, it simultaneously suppresses your prefrontal cortex, the part of your brain responsible for rational decision-making and risk assessment. You're literally less capable of evaluating price, quality, or need when you're in a nostalgic state. From a corporate perspective, this is perfect. They're not fighting against your rational mind, they're bypassing it entirely. And there's more. Nostalgia creates what psychologists call temporal landmarks, moments that feel important enough to organize your life story around. Your first concert, the toy you wanted for Christmas, the commercial that played during Saturday morning cartoons. These aren't just memories, they're anchors. And once something is anchored to your identity, you'll defend it, you'll pay for it, you'll argue with strangers on the internet about it. So how do companies actually extract value from something as intangible as memory? Let's break down the mechanism. Every generation has a golden age window, typically between ages 10 and 25. During this period, your brain is forming the strongest emotional memories of your life. The music you hear, the movies you watch, the products you consume during this window will be neurologically privileged for the rest of your life. Marketers know this down to the year. They can calculate exactly when a generation's nostalgia will peak and become profitable. For millennials born between 1985 and 1990, that window opened around 2015 and is still wide open today. For Gen X, it opened in the early 2000s. For Gen Z, it's opening right now. This is why you're seeing reboots of shows from the 1990s and early 2000s. This is why fashion from 2000 to 2005 is suddenly back. They're not guessing, they're following a demographic timer.
Here's a counterintuitive truth. The best way to make something valuable tomorrow is to discontinue it today. Companies don't just let products naturally fade away, they strategically remove them from the market, creating artificial scarcity that will be exploited later. Think about McDonald's McRib. It's not a seasonal item because of pork supply chains. It's seasonal because scarcity creates nostalgia, and nostalgia creates demand. Every time it returns, it's an event. People post about it, they make pilgrimages, they pay premium prices, all because it wasn't there and now it is. The same principle applies to streaming content, limited edition products, and vault releases. Disney pioneered this with their vault strategy in the VHS era, artificially restricting access to classic films, then re-releasing them every 7 years to a new generation of parents. Each release generated hundreds of millions in revenue from the same content. When the nostalgia curve peaks, when enough time has passed that the memory is golden, but not so much that the audience is too old to spend, companies reintroduce the product, but never at the original price point. Nostalgia commands premium pricing, always. The Nintendo Entertainment System originally retailed for $199 in 1985. Adjusted for inflation, that's about $570 today. When Nintendo released the NES Classic Edition in 2016, a miniature version with 30 preloaded games, it retailed for $60. Within weeks, scalpers were selling them for $300 to $500. Nintendo wasn't selling a gaming console. They were selling 1987 back to people who lived it. The profit margin on nostalgia is extraordinary because the R&D costs are zero. The product already exists, the brand awareness already exists, the emotional connection already exists. All the company has to do is repackage it and watch people fight to hand over their money. Let's examine one of the most perfect examples of weaponized nostalgia, the beverage industry, specifically Coca-Cola and Pepsi. In 1985, Coca-Cola made what business schools call one of the biggest marketing blunders in history. They reformulated their product and launched New Coke. The backlash was immediate and visceral. People hoarded old Coke, they protested, they called it un-American. Within 79 days, Coca-Cola brought back the original formula as Coca-Cola Classic. Here's what's fascinating. New Coke actually tasted better in blind taste tests, consistently, significantly. So why did it fail? Because people weren't drinking a beverage, they were drinking their childhood. They were drinking 4th of July barbecues and Christmas dinners and their grandfather's refrigerator. Coca-Cola had accidentally tried to change a memory, and the market revolted. But here's the deeper story that most people miss. Was it really an accident? After New Coke's failure, Coca-Cola Classic sales skyrocketed. The company's market share increased. Brand loyalty intensified. By threatening to take away people's past, Coca-Cola made them realize how much they valued it. Whether intentional or not, New Coke became the most successful failure in marketing history. Pepsi learned a different lesson. They couldn't beat Coca-Cola on nostalgia. Coke owned that territory. So Pepsi positioned itself as the choice of the future, the next generation. But watch what Pepsi does now. They've launched Pepsi Throwback with real sugar. They've recreated vintage logos. They've brought back Crystal Pepsi, a failed product from 1992, multiple times, not despite its failure, but because of it. The failure itself became nostalgic. The beverage in the can is almost irrelevant.
Both companies are selling temporal identity. They're selling you a ticket back to when you were younger, and people will pay any price for that ticket. If you want to see nostalgia economics in its purest form, look at vinyl records. Here's a product that is objectively inferior to modern alternatives in almost every measurable way. Vinyl records are fragile. They degrade with each play. They're expensive to produce and ship. They require specialized equipment. They have limited dynamic range compared to digital formats. They can't be portable in any practical sense. And yet, vinyl sales have grown every single year since 2006. In 2023, vinyl outsold CDs for the first time since 1987. The vinyl market is now worth over $1.2 billion annually. Why? Because vinyl isn't a music format, it's a nostalgia delivery system. When someone buys a vinyl record, they're not optimizing for sound quality or convenience, they're purchasing the ritual. The act of removing the record from the sleeve, placing it on the turntable, watching it spin, lifting and lowering the tone arm. These are theatrical gestures that have nothing to do with the music and everything to do with recreating a temporal experience. Record companies understand this completely. New vinyl releases are priced at $25 to $40, approximately 2 to 3 times the cost of a CD, and infinitely more than a streaming subscription that offers access to millions of songs. The profit margin on vinyl is enormous because buyers aren't price sensitive. They're making a rational economic choice. They're making an emotional purchase disguised as a music purchase. And here's the brilliance. Vinyl creates nostalgia even for people who never experienced the vinyl era. Gen Z buyers, people born after CDs were already dominant, are now the fastest growing segment of vinyl consumers. They're buying nostalgia for an era they never lived through, a past they've only seen in movies and heard about from older generations. This is the final evolution of nostalgia economics, selling people a past they didn't even experience.
Let's talk about the film industry, where nostalgia has become the dominant business model. Between 2010 and 2024, over 65% of the top-grossing films were sequels, reboots, or adaptations of existing intellectual property. Original screenplays have become financial risks. Nostalgia is the safe bet. Why? Because nostalgia dramatically reduces marketing costs and increases opening weekend predictability. When you announce a sequel to a beloved 1980s franchise, you don't have to convince anyone to care. They already care. The emotional investment already exists. You're not selling a new story. You're selling people access to their younger selves. Consider the math. The original Top Gun cost $15 million to produce in 1986 and grossed $357 million worldwide. Top Gun Maverick, released in 2022, cost $170 million, but grossed $1.5 billion. That's not just inflation, that's nostalgia premium. The people who saw the original Top Gun in theaters in 1986 were teenagers and young adults. In 2022, they were in their 40s and 50s, peak earning years, peak disposable income, peak willingness to spend money reliving their youth. The sequel wasn't targeting a new generation, it was targeting the original audience's bank accounts, now significantly fuller than they were in 1986. And it worked perfectly. But here's what makes this particularly fascinating from a financial psychology perspective. These reboots don't have to be good, they just have to exist. Indiana Jones and the Kingdom of the Crystal Skull was critically panned and widely considered the worst film in the franchise. It still grossed $790 million. People paid to be disappointed because the act of purchasing the ticket itself was nostalgic. The film's quality was almost beside the point.
This is why studios will continue making sequels and reboots indefinitely. The audience has been trained to show up regardless of quality. The nostalgia itself is the product. The movie is just the delivery mechanism. Fashion operates on what industry insiders call the 20 years rule. Styles from 20 years ago reliably become fashionable again. This isn't taste, this isn't aesthetics, this is demographic economics. 20 years is the exact amount of time required for a generation to reach peak earning power and peak nostalgia for their youth. The people who wore a style as teenagers now have the disposable income to buy it again, but this time at luxury prices. In the early 2000s, 1980s fashion came roaring back: shoulder pads, neon colors, high-waisted jeans. In 2020s, early 2000s fashion is back: low-rise jeans, butterfly clips, Von Dutch hats. In 2030, you can expect 2010s fashion to return. This is so predictable that fashion companies actively archive trends, waiting for the demographic clock to strike midnight. They're not creating new designs, they're warehousing old ones and timing their release to coincide with maximum nostalgia impact. But here's the mechanism that makes this particularly profitable. Each revival commands higher prices than the original. When low-rise jeans were originally trendy in 2003, you could buy them at Gap for $40. When they came back in 2023, designer versions sold for $300 to $500. Same style, same materials, different price point. Why? Because the buyer isn't purchasing jeans, they're purchasing 2003. They're purchasing their 17-year-old self. And that person, that memory, is worth significantly more than denim.
The most sophisticated evolution of nostalgia economics is the subscription model. Instead of selling you your past once, companies have figured out how to charge you for it monthly, indefinitely. Disney+, HBO Max, Netflix's library of nostalgic content. These platforms aren't competing primarily on new content. They're competing on how much of your past they can lock behind their paywall. Disney+ launched with almost no new content. What it had was the Disney Vault, decades of content that people already knew and loved. Within 18 months, it had over 100 million subscribers, paying $8 to $15 per month. That's over $1 billion in monthly recurring revenue, mostly for content that was produced 20 to 60 years ago. The production costs? Already recouped decades ago. The profit margin? Nearly 100%. This is the holy grail of nostalgia economics. Convert one-time purchases into permanent revenue streams. You used to buy a VHS tape of The Lion King once. Now you pay every month to maintain access to it. You don't own your nostalgia anymore. You rent it. And here's the most important detail. Companies are systematically removing content from free or purchase-based access to force it behind subscription paywalls. Content that used to be available on ad-supported platforms or for one-time purchase is disappearing, only to reappear on subscription services. You're not just paying to access content, you're paying ransom to access your own memories. Video games have become one of the most profitable nostalgia markets because games uniquely combine multiple forms of memory: visual, auditory, and most importantly, procedural memory, the memory of how to do something. When you replay a game from your childhood, you're not just remembering the story or graphics. Your hands remember the controls. Your fingers remember the patterns. This creates an embodied nostalgia that's even more powerful than visual or musical nostalgia. Companies have recognized this and responded with a remake industry worth billions. The Resident Evil 2 remake cost approximately $10 million to produce and grossed over $100 million in its first month. Final Fantasy VII Remake cost significantly more, but generated over $1 billion in revenue.
These aren't new games, they're old games with new graphics, and they're outselling most original titles. But here's the mechanism that makes gaming nostalgia particularly profitable. The remake doesn't compete with the original. People who own the original will still buy the remake. They're not replacing their memory, they're supplementing it. They're paying to experience their 12-year-old self with their 35-year-old budget. And gaming companies have learned they can release the same game multiple times: the original, the remaster, the remake, the definitive edition. Each one commands a new purchase from the same audience. Each release is positioned as the way you remember it, or the way it was meant to be played. The product hasn't changed, the memory has just been repackaged.
Now that we understand the mechanisms, let's examine the incentive structure that makes nostalgia not just profitable, but inevitable. From a corporate perspective, nostalgia has several advantages over innovation. Lower risk. You already know the audience exists. You already know they have emotional attachment. You already know they'll show up. Lower marketing costs. The audience markets for you. They share nostalgic content organically. They debate it online. They generate free publicity through their own emotional investment. Built-in demand. You're not creating desire, you're activating existing desire. The work of making people care has already been done, often decades ago. Premium pricing justification. Nostalgia commands higher prices without resistance because the buyer isn't comparing features or value, they're comparing feelings. Generational predictability. You can forecast nostalgia peaks with demographic precision. As each generation ages into peak earning years, you know exactly what they'll want and when they'll want it. From a shareholder perspective, nostalgia-based revenue is more reliable than innovation-based revenue. Innovation might fail. Nostalgia never fails. It just waits. This creates a self-reinforcing cycle. The more companies invest in nostalgia, the more profitable it becomes. The more profitable it becomes, the less incentive there is to take risks on new ideas. The less risk taken, the more consumers long for the old days when things felt fresh and original, which makes them even more susceptible to nostalgia marketing. It's a perfect loop, and everyone inside it is making money. Here's where it gets really interesting from a long-term financial perspective. Nostalgia is a renewable resource that automatically generates new markets. Every 10 to 15 years, a new generation reaches the age where nostalgia becomes financially viable. Right now, companies are mining millennial nostalgia, but they're also preparing Gen Z nostalgia products. And they're already studying Gen Alpha to understand what will trigger their nostalgia in 2035. This means the same business model can be repeated indefinitely with different cohorts. You don't need new strategies, you just need to identify what each generation considers the good old days and sell it back to them when they can afford it. The industry figured this out decades ago. Every generation thinks their music was the last great era of music. Every generation is willing to pay premium prices to hear it again. Streaming services and radio formats can simply rotate through different decades, targeting different age demographics, all playing content they paid for once and now can license infinitely. The fashion industry does the same thing with 20-year cycles. The film industry with reboots timed to generational aging. The food industry with limited edition returns of discontinued products. It's all the same mechanism, just with different timing.
Let's step back and look at what's actually happening here from a systems perspective. Every experience you have is being cataloged, not by you, but by the market. Every product you consumed as a child is sitting in a corporate archive somewhere, waiting for you to age into the demographic window where you'll pay the most to see it again. Your memories aren't yours in any exclusive sense. They're shared inventory. They're assets on a balance sheet. They're line items in a 20-year business plan. This isn't a conspiracy. It's not hidden. It's just extremely efficient capitalism. Companies would be irrational not to exploit this. They have a fiduciary responsibility to their shareholders to extract maximum value from their intellectual property. And the highest value extraction comes from timing the release of nostalgic content to coincide with demographic purchasing power. You are not being manipulated in any traditional sense. You're being served exactly what you want, when you want it most, at a price you're willing to pay. The fact that this want was planted decades ago and has been carefully cultivated doesn't make it less real. It makes it more valuable. This is the ultimate efficiency of modern capitalism. Companies no longer need to create desire. They just need to wait for it to ripen. There's one more layer to this that's worth examining: opportunity cost. Every dollar spent on nostalgia is a dollar not spent on something new. Every reboot that gets greenlit is an original screenplay that doesn't. Every remake that gets funded is a new game that doesn't exist. From a market perspective, this makes perfect sense. Nostalgia is more profitable than innovation, so capital flows toward nostalgia. But from a cultural perspective, we're entering a strange equilibrium where the past becomes more valuable than the future. We're not just recycling content, we're recycling time itself. The 2020s are becoming a decade dedicated to re-experiencing the 1990s and 2000s. The 2030s will likely be dedicated to re-experiencing the 2000s and 2010s. Each generation is spending more time looking backward than the generation before it, not because the past was objectively better, but because the financial incentive structure makes looking backward more profitable than looking forward. This is neither good nor bad. It's simply the reality of how markets respond to human psychology. Companies aren't forcing anyone to buy nostalgic products. They're simply offering them, and people are choosing to buy. The choice is genuine. The desire is real. The market is just exceptionally good at predicting when that desire will peak and positioning products accordingly.
We're currently entering what economists might call the acceleration phase of nostalgia economics. The cycle is speeding up. It used to take 20 years for something to become nostalgic. Now it takes 10, sometimes 5. Stranger Things triggered 1980s nostalgia, but it also triggered nostalgia for 2016, when Stranger Things first premiered. We're becoming nostalgic for nostalgia itself, creating nested layers of temporal longing that companies can exploit multiple times. TikTok trends cycle through decades weekly. One day it's 1990s fashion, next day it's 2000s music, next day it's 2010s slang. Each trend is a micro-nostalgia event, a tiny hit of dopamine from remembering something that happened recently enough that it shouldn't even feel like the past yet. This acceleration benefits companies because it means they don't have to wait as long to monetize content. Something that premiered in 2015 can be positioned as nostalgic in 2025. The faster the cycle, the more often they can sell you the same feeling. So here's where we are. You have memories. Those memories have value. Companies know that value down to the dollar. They know when you'll want to access those memories most. They know how much you'll pay. And they've built an entire infrastructure around extracting that value as efficiently as possible. This is not a criticism. This is description. Nostalgia marketing works because it gives people something they genuinely want: connection to their past, comfort in an uncertain present, the feeling that something they loved is still relevant. Companies profit because they're solving a real psychological need. The transaction is voluntary. The value exchange is real. Nobody is being tricked.
You know you're buying nostalgia. You might even know you're being marketed to. And you buy anyway, because the feeling is worth the price. That's not exploitation. That's just the market finding equilibrium between what people want and what companies can provide. The fact that what people want is their own past and companies can provide it infinitely at increasing margins is just efficient. The only question that remains is personal. Knowing all this, knowing exactly how the mechanism works, knowing that your memories are inventory, knowing that your childhood is a renewable resource being harvested on a predictable schedule, does it change anything? Will you still buy the reboot? Still subscribe to the streaming service? Still purchase the vinyl record and the retro sneakers and the limited edition re-release of the cereal you ate in 1995? Most people will, and that's fine, because understanding the system doesn't mean you have to reject it. Sometimes you're buying nostalgia. Sometimes you're just buying breakfast cereal. The line between the two is thinner than you think, and companies have spent billions making sure you can't tell the difference. Your memories are valuable. You know it, they know it. The only difference is they've figured out how to put a price on something that used to be priceless. Welcome to paper reality, where your past is someone else's present profit margin. If this changed how you see the products, the reboots, and the limited time-only returns of things you loved, hit that subscribe button. We examine the invisible systems that shape your decisions every week. Like this video if you want more financial psychology breakdowns, and comment below, what's the most you've ever paid for pure nostalgia? No judgment, just data.